I think the key message is that there's risk on sentiment in the market, which is great to see after a couple of tougher years. How do we know this? Well, we interview about 900 third-party fund selectors every year for our European Fund Selector Study. The latest results of the Wave 3 for this year have just come out with fieldwork from March to May of both retail and institutional selectors. So if we hone in on the sort of two core asset classes of equity and fixed income, equity sentiment in particular has improved this year versus last year, especially so in the retail space. So I think from an institutional perspective, we'd expect to see more rotational activity. From a retail perspective, we'd expect to see more net new money coming to the table, perhaps having seen the strong performance of last year. On the fixed income side, sentiment is also positive, perhaps down ever so slightly from this time last year. Again, perhaps due to that risk on environments and more money moving in the direction of equities. If we drill down into sector level, we can see some interesting shifts at play within fixed income, such as demand moving more towards corporate investment grade as the spreads look relatively more attractive over sovereign debt, although we're still seeing positive appetite for that. And interestingly, retail selectors are talking about making relatively large decreases to their money market allocations, which are normally a pretty solid risk-on sign too. I think it's an interesting question. It's an interesting space. Europe is at a much more nascent stage of the journey than America. In the US, you've got about $700 billion in active ETFs already. In Europe, about $40 billion or thereabouts, growing quickly, but from a small base. And the two regions have got quite different dynamics. So Europe doesn't have that same sort of tax incentive to investing in ETFs that you do in the States. And the distribution environment is quite different. The ongoing commissions payment regime within the retail space in particular is a headwind to ETF adoption in generally for retail investors. That said, we have asked the question this year to the fund selectors we survey about active ETFs, and familiarity and demand as well are looking pretty high. So about 80% of selectors said they are at least familiar with active ETFs. Around about 20% said they're already allocating. Personally, that sounds like quite a high proportion to me. So I'm wondering whether some of them are conflating active ETFs with smart beta, strategic beta ETFs, sort of in between the passive and active space. Nonetheless, there's clearly familiarity there. There's clearly appetite too. So I think it's definitely a space to watch. So I think if we look at industry flows data, that showed that after a positive start last year, sales did turn negative for quite some time, but they're back in the black again this year. Now, interestingly, ESG, responsible investment, is of the 8 different asset classes and investment types that we test for sentiment. Sentiment is higher than in any other area. So that kind of contradicts almost the negative news flow that you're hearing around ESG at the moment. But I think there are a few reasons why we're seeing that strong sentiment. I think for some of the selectors, both on the retail and institutional side, ESG has become a little bit of a hygiene factor. It's seen as the right thing to do, the right thing to continue doing. And we also hear this when we interview selectors directly for qualitative research. So we interviewed a series of selectors back in Q4 last year in France, Germany, Switzerland, and Italy. And although they did express concerns around greenwashing, some negativity around reporting standards or confusion about all the different sort of reporting regimes that exist around ESG in particular, medium to long term, they are quite positive. I think it's the right thing to do by people and planets. And I think there's a bit of a demographic shift in play as well, that as younger generations become the sort of core investor base, these characteristics and qualities are perhaps a little bit closer to their heart. So that's going to act as a driver as well to further future uptake. But ultimately, I think it's seen as a bit of a must-have in portfolios, no matter the weather. So among those who are already investing in private assets, we saw the biggest jump in net sentiment. So that's quite an interesting change year on year. I think that there is a lot of positivity. It's looking more positive actually within the retail space than institutional, which again, because that's growing from a smaller base, perhaps isn't so surprising. But I think it's importantly showing that there is a demand side to this equation. It's not all just about supply in the industry conversation about retailizing or democratizing private assets products. So yeah, for sure, we are seeing this increase in sentiment. It's focused in particular around private equity, which I guess in the hierarchy of the different private asset classes is the most well known. So it's the obvious first stop for investors too. That said, it's not, a walk in the park. There are many obstacles to getting involved in private assets. And when we ask selectors, what these are, by far and away this year, liquidity was the main one that they mentioned. So the illiquidity of the underlying holdings is a big blocker, I think, to getting involved. That can include, difficulty accessing them on platforms as well to an extent. One interesting change on that front year on year is a decline in regulatory concerns when it comes to private assets. And we think that's linked to the fact that, the EU and the FCA in the UK have given the stamp of approval, if you like, to this space, to certain wrappers such as the LTIF in the EU, the LTAF in the UK. And that's providing investors with some comfort, I think, that the regulators are getting behind this shift. I think one other point to make on the LTIF in particular is sort of where levels of familiarity currently are. So we asked selectors what they think, what they know about LTIFs, and just over 50% of continental selectors, so putting the UK to one side, just over 50% said they are at least familiar. You can flip that around and say, well, around 50% don't know what an LTIF even is. So there's an education piece involved in this as well. But familiarity is not bad. And uptake, early days still stronger in Italy, where there have been some tax incentives around this for some time. But I think we're beginning to see those seeds of interest and appetite for that vehicle, and therefore for more retailization of private assets generally. In some ways, it's a little bit more of the same. So they have certain qualities they're looking for when they are selecting an asset manager, when they're reviewing the asset managers they work with. When we ask them to sort of rank them, these sort of characteristics, it's some fairly obvious ones that come out on top. One is investment performance, one is investment strategy, another one is the stability of the investment team. There are others that they see as pretty important, perhaps not top of the list, but things like brand recognition, ESG strategies, pricing and costs, pretty important, and sort of midway up that list too. I think other qualities that come to the fore, and we see this more when we're speaking with selectors, such as in Q4 last year, communications and relationships as well. These are seen as super important by selectors when they're thinking of asset managers. And they give some pretty solid examples. Some of them talk about the speed at which fact sheets or marketing material makes it to them from their different providers. And you can have a huge difference from a couple of days to a couple of weeks, and that's noticed. And it does it leaves a sort of a residual sentiment in their minds towards particular brands. I think also last year communications really came to the fore because performance had not been great the year before. That was still feeding through to the end clients. It was still something that needed, the message needed managing around that. And again, the selectors mentioned that some of their providers were great. They can deal with the news flow, whether it's good or bad. They're always by the side of selectors. Others do a little bit of an ostrich and stick their head in the sands and hope that the bad news is going to go away. So again, this can make a real difference in terms of how a provider is perceived. Ultimately, the selectors are looking for someone they can trust, they can rely on when they're doing business.